What is a monetary system? Imagine a world without money. No coins, no paper notes, no digital transactions. It would be chaos, right? That's where a monetary system comes into play. It's the organized way a government manages the creation, distribution, and regulation of money in a country. Think of it as the backbone of economic activity, helping people buy goods, pay for services, and save for the future. A monetary system involves institutions like the national treasury, which handles government funds, and central banks, which control the money supply and interest rates. Commercial banks are part of this system too, offering accounts and loans to everyday people and businesses. Laws and rules govern how all these parts work together, making sure the flow of money stays stable and trustworthy. Looking back in history, early monetary systems used physical items with intrinsic value, like gold, silver, or even seashells. These commodities were stamped or marked by authorities to prove their weight and purity, so everyone knew they could trust their value. This was the start of using money as a medium of exchange and a store of value. As economies grew more complex, people started using representative money. This was paper or tokens that didn't have real value themselves but could be exchanged for a fixed amount of gold or silver. For example, during the gold standard era, paper notes could be swapped for gold at a set rate, making transactions easier without carrying heavy metal coins. The most recent form is fiat money, which is currency issued by governments without backing by physical commodities. Its value depends on the trust people have in the government that issues it. The first known use of fiat currency was in China during the Song dynasty around the 10th century. Today, most countries use fiat money because it allows governments to control the economy better, especially when adjusting interest rates or managing inflation. Throughout history, monetary systems have helped shape human progress. The introduction of coinage in ancient Lydia around the 7th century BC created a standard currency that spread across Greek city-states, boosting trade. Later, the creation of central banks and national currencies helped stabilize economies and regulate how much money was in circulation. This balance prevented inflation from spiraling out of control and kept economies functioning smoothly. In everyday life, a monetary system determines how money moves around, how prices are set, and how governments implement economic policies. For example, the Federal Reserve in the United States manages interest rates and controls the amount of money in circulation to support economic growth and keep prices stable. Understanding how monetary systems work shows how humans have continuously innovated to make trade easier and economies stronger. From barter and commodity money to digital currencies and electronic banking, these systems reflected the ongoing effort to organize and improve how societies handle money and power.